Hi, I'm Sean, a finance nerd, and today we're talking about whether you should drain all of your savings to buy a house outright in cash. I'm joined in this conversation by my co-host, Sara Rathner, and NerdWallet mortgage nerd, Kate Wood.
This episode's question comes from Lena, who emailed us their question. Here it is. My husband and I are hoping to buy a house and stop renting, but the interest on houses is very high. I hate to see how much of the mortgage is going to the interest on the loan. We do have the opportunity to buy a house outright, but it would take all our savings in our high yield savings account. We're getting about $350 a month from interest in our savings. So using that money to buy a house would get rid of that, but we wouldn't have rent, and we could save up very fast to get that money back where it was, probably within a few years. I know it's not ideal to put most of your money in a house, but in our situation, do you think this is better than paying a high monthly mortgage for 15 years? Thank you for your help. Love the podcast, and I hope you all are doing well.
To help us answer Lena's question on this episode of the podcast, we are joined by mortgage nerd Kate Wood. Kate, welcome back to Smart Money.
Thanks for having me back.
So we'll get to Lena's anxiety-inducing question about using all of their savings to buy a house outright in a moment. But first, I want to talk about interest rates. That's been the big story in the housing market over the past few years. So, Kate, where do they stand now?
Well, mortgage rates have been hovering in the 7% range for most of 2024. They're a little bit softer now, but they've been kind of around there. And, yes, that is very high compared to the record lows that we saw in 2020 and 2021, back when, mortgage rates were in the 2 to 3% range. But 7% is not at all high historically, or really in the scheme of things. So Freddie Mac has tracked mortgage rates since 1971, and the long-term average over that time is 7.41%. So, you could say okay, but, rates were more in the 4% range for kind of all of the 2010s. So this is still really high. But I really feel like we need to let go of the idea that mortgage rates could go to rock bottom again at any minute, or that that's where they should be. This was really an anomalous circumstance during the pandemic. And, for what it's worth, interest rates on mortgages are still among some of the lowest interest rates that you're going to get if you're borrowing money.
I get where our listener is coming from, though, because sure, a 7% loan is a lot lower than the rate that you would pay on a credit card, but the scale of the debt is so much different. Hopefully people do not have hundreds of thousands of dollars of credit card debt, but 7% on a mortgage that is for hundreds of thousands of dollars does amount to hundreds of thousands of dollars in interest alone. And another big factor that makes the current interest rates intimidating is that homes have just gotten so much more expensive over the past few years. So I don't want to minimize the impact of interest rates on affordability, but Kate, you are right that compared to historical rates, what we're seeing now is not unheard of.
Yeah. If I could jump in for a second, something that I keep trying to emphasize to people is that yes, mortgage rates are bad, but rates are just the storyline villain here. Home prices are the actual villain, right? If you want to look at something over time and how it's changed and is it way out of whack with kind of what should be reality, it's home prices.
Okay, looking back at mortgage rates, whenever we talk about them, we're also talking about the Federal Reserve and this question of will they or won't they lower interest rates. It's very dramatic. So can you talk a little bit about what's going on over at the Fed right now?
Sure. So things are kind of really going to plan for the Fed, but also kind of not, right? So on one hand, it looks like they're possibly engineering a soft landing, right? So slowing down inflation, slowing down the economy without the US dropping into a recession. And that's pretty amazing, right? But at the same time, they haven't done that enough that they're in an environment where it's you know what, we can maybe stop doing what we're doing for a little while, ease up, let cash flow get a little bit stronger, right? Because until very recently, literally the most recent jobs report, the US economy has been really strong this year. It's been, continuing to add jobs, and inflation has been really resilient. And so that has really hindered the Fed's ability to move forward because they're really focused on a 2% goal when it comes to the rate of inflation that they're looking to see. At the beginning of the year, everyone was really excited, yes, 2024 is the year we are headed into a rate cutting cycle. And now, with pretty much almost every round of economic data that we're getting, that date keeps getting pushed back. Now, with the most recent employment numbers, the tide could be turning, but it's still not outside the realm of possibility that we don't see a rate cut from the Fed this year.
I'm guessing that is not the news that many of our listeners wanted to hear. And even if we do get a rate cut, it might take a while to actually see that trickle down to mortgage rates, right?
Absolutely. Even if we were to see a rate cut, we're talking about something like 0.25 percentage point at a time. So these are very small cuts. And then that's going to take time to filter out to other rates like mortgage interest rates. When we talk about the Fed cutting rates, they're cutting a rate. They're cutting the federal funds rate, which is like an index rate for banks lending to each other overnight. So that influences lots of other rates, but it doesn't directly control them. It's not directly moving them up and down. The other thing with mortgage rates that's really keeping them elevated relative to when they were able to go super low is that not only were they able to go low, in 2020, 2021, because, the Fed cut the federal funds rate to virtually zero, but also because at that time, the Fed was buying tons, like billions of dollars of mortgage-backed securities. So mortgage-backed securities are sort of like bonds. They're basically, bundles of home loans. And when the Fed was buying all of these mortgage-backed securities, that gave mortgage lenders the ability to cut their rates particularly low because they knew they had a buyer. Even though, they were making these very inexpensive loans, they always knew they were going to be able to package them up, sell them to the Fed. But now the Fed has stopped buying mortgage-backed securities, and the ones that that are maturing, they're just letting them roll off. So they're owning fewer and fewer of them, and lenders, don't have an assured buyer for their loans. So it's harder for a lender to just say, you know what, we could be really competitive if we cut our interest rates, because if they did that, they might be stuck keeping those loans on their books.
So going back to individual home buyers, for many, a difference in interest rates of just a few points can mean the difference between being able to afford a house or not. But if our listener is in a place where they can buy a house outright in cash, I'm wondering if they're maybe getting a little too hung up on the interest rate thing. What do you think?
Like, in a word, yes. Although I think also too, something that's getting lost here is, the decision about where to live isn't just a financial decision. Obviously, it's a financial decision in that, this is a tremendous amount of money. It might be the largest transaction you make in your life, but it's not only a financial decision. It's also like a really emotional and really personal one, because this is your home. This is where you're going to live, right? It's not just an investment.
Yeah, I also think it's worth thinking about how an interest rate is really just the cost of having a loan. And in the case of having a mortgage, that would mean that this listener would be able to hold on to some of their savings and, I don't know, maybe enjoy their life, go on vacation, fund the inevitable repairs that come with owning a home instead of having all of their cash tied up in a house. Okay, well, let's address the big question head on. And since we do not give specific, personalized financial advice on this show, I'm going to turn the question over to you two, Sara and Kate. Would you spend all of your savings to buy a house outright instead of maybe getting a 15-year mortgage? And why is the answer a resounding no?
Well, I mean, so there are kind of like multiple reasons that it's a resounding no. And I would point out, like, this isn't about, that we're using cash to make this purchase. This is about the idea that you would be using all of your savings, that you'd be using all of your money. So even, if we're talking to folks who are getting a mortgage and they're just considering like, well, in order to afford the house I want, and pay for the down payment, the closing costs, all the other things that come up, I'm going to be spending every single dime of my savings to do that. Our general advice is like, don't do it, buddy. Because there are, like Sean was just saying, there are so many things that come up when you buy a home, whether it's like unexpected repairs or just like a billion trips to the home center because you need more like painter's tape, or potting soil, or just like the expenses just mount and mount. And they might not be, huge dollar amounts, but you need some kind of income to deal with them. So really, whether you're talking about buying a house in cash, which like, if you can do it, makes you a super competitive buyer, right? Or if you are, saving up to buy a house with a mortgage, really, our consistent advice is that you don't want every last dollar tied up in that, because life happens, like things happen.
Yeah, I cannot stress enough not just how expensive it is to buy a home in the first place, but to maintain the home, to furnish the home. If you drain your savings just to get into that home, it's going to sit empty and broken until you rebuild your savings back up. And the listener does mention, well, if we don't have rent anymore, we can build our savings back up pretty quickly. And I don't know what their full financial picture is, including income and other sources of funding that they have. But for, let's say, the average person, you're not going to be able to build your savings back up as quickly as you might think, because there's always another crisis. And it's not just with your home, but also just your life. There could be a medical crisis or something else that eats into your savings. Keep in mind that typically rent is the most you'll pay for your housing in a month, not including utilities, whereas a mortgage is typically the least you'll pay. Add on to the mortgage, the utilities, the maintenance, the repairs, even just the nice decorative stuff that you want to do. It's constant. The money is constantly bleeding from your account.
I also don't want to give the impression that it's never a good idea to buy a house with cash. If you have enough cash to buy a house and plenty of other cash sitting in a savings account that is liquid and accessible, first of all, congratulations. I'm a little bit jealous of you. In that case, you might be fine. But with this listener situation, they're discussing draining all of their savings to buy a house, which is extremely risky. If you don't have any cash in your savings, you're basically asking the housing gods to flood your basement or like drop a tree limb on your house or something. It's just always a smart idea to keep a decent amount of savings liquid for the inevitable repairs that do pop up when you own a home. Thanks for watching. I'm Sean Pyles, host of NerdWallet's Smart Money Podcast. If you learned something new today, hit like and subscribe and share with your friends. Also, listen to NerdWallet's Smart Money Podcast wherever you get your podcasts.